After performing exceptionally well for the past year, the REIT market suffered a little dip in recent weeks, and as a result, quite a few of them have become opportunistic again. Moreover, most REITs have kept hiking their dividends, and as a result, REIT dividend yields have expanded significantly in some cases. While a few years ago it was hard to find yields in excess of 6%, today there are plenty of REITs offering sustainable and growing dividend yields of up to 10%. Hey everyone, this is YCHARTS, a small investment firm that specializes in REIT investing, and in today's video I'm going to highlight 3 examples of very high yielding REITs that we are buying at the moment for our portfolio at High Yield Landlord. By the way, if you want to access our full portfolio, we are currently offering a 2-week free trial as well as a $100 discount for Black Friday. It will be the first link in the description of this video. So the first REIT I'm going to discuss is called Armada Hoffler, it's ticker symbol AHH. This is the only REIT that focuses on mixed-use properties which commonly combine retail, residential, office, and other uses all under one roof. These are very desirable properties that commonly command large rent premiums compared to single-use assets and maintain high occupancy rates during all times. The mixing of the different uses leads to a lot of synergies for retail, office, residential. It increases the convenience, the livability, and the walkability of the asset. But unfortunately for Armada Hoffler, the market does not seem to understand the appeal of these live, work, play properties. What the market sees is that Armada generates about 1/3 of its cash flow from office space, and this has hurt its market sentiment, causing it to trade at a heavily discounted valuation. I'll put a table on the screen comparing the valuation of Armada Hoffler to that of the average of the REIT sector, and you'll see that the discount is very steep, and we think that this is a mispricing. A low multiple of 8.5 times FFO signals that the company is facing severe headwinds, but the opposite is true here. Residential properties generally warrant a premium valuation. Its close peers like Camden Property Trust, Mid-America, Apartment Communities, and so on are trading at closer to 15 to 20 times FFO. Then retail is today the hottest of all property sectors due to the relative lack of new supply and rapid rent growth. Peers like Federal Realty Trust and Regency Centers are today trading upwards of 15 times FFO. Finally, Armada Hoffler's office space is exactly the type that you would expect to thrive over the long run, as increasingly many tenants switch to a hybrid work setting and relocate to high-quality office buildings in more convenient locations. Its office buildings enjoy very high occupancy rates, very long leases, mostly with investment-grade rated tenants, and it's able to keep on growing its rents even in today's environment. Finally, while Armada uses a bit more leverage than other REITs, its balance sheet still remains very reasonable with a 45% loan-to-value and even has a BBB+ investment-grade rating. Therefore, I would expect Armada Hoffler to keep doing just fine over the long run. This is a high-quality REIT with great assets, a strong balance sheet, and the management has a very good track record, having managed to outperform the broader REIT market up until the pandemic. But that's when the office fears started. It has depressed the market sentiment of the REIT and its valuation is yet to recover. As a result, you today have the chance to buy it at a heavily discounted valuation with a near 8% dividend yield, which is safely covered at a 75% payout ratio. The REIT has consistently hiked its dividends in recent years, and we expect this growth to continue. We estimate its fair value at around 14 times FFO, and getting there would result in about 50% upside from here, and the high yield will help us to stay patient in the meantime. Hey, before I go into the second REIT, can you please do me a huge favor and click the like button? That helps me a lot to keep on growing. Thanks so much in advance. Then the second REIT I'm going to discuss is called EPR Properties, ticker symbol EPR. This REIT finds itself in a similar situation as Armada Hoffler in that its assets and risk profile seem to be misunderstood by the market, and it's causing it to trade at a higher yield and lower valuation than it should. EPR owns mostly experience-oriented net lease properties such as golf complexes, water parks, ski resorts, movie theaters, and the market seems to fear that we'll suffer if and when we go into a recession because these properties rely on discretionary spending. This view is very evident if you look at the comment sections of articles on Seeking Alpha or even my videos on YouTube. You'll often see people write that they are avoiding EPR due to recession fears. But what these investors seem to ignore is that EPR is a net lease REIT and its average remaining lease term is over 10 years. Its rents are preset for this entire leases, and they even include 2% annual rent escalations, and therefore its rent should keep on growing even if we go into a recession. The only risk would be if its tenants default on their leases and vacate the property, but its rent coverage ratios are today at a historic high of 3.2 times, which means that its tenants are highly profitable at the property level. In fact, they are so profitable that they could see their profits drop by half and they will still be profitable at the property level. Therefore, EPR enjoys significant margin of safety and its tenants will be unlikely to default on their leases even in a recession. And even if its tenants suffer temporarily in a recession, they are unlikely to want to lose profitable long-term assets due to short-term disruption. And the best proof of that is what happened during the pandemic. This was the worst possible crisis for a REIT like EPR. And even then, its tenants wanted to keep these assets and they found solutions with EPR to remain its tenants. I would actually argue that a regular recession would benefit EPR as it would lower interest rates. And the main risk of some of EPR's tenants today is their over-leveraged balance sheets rather than their operations. And in that sense, lower interest rates will benefit them and also improve EPR's market sentiment. Then, just like Armada Hoffler, EPR also has an investment grade rated balance sheet and a track record of significant market outperformance over the long run. Despite that, it trades today at a heavily discounted valuation and a high dividend yield of about 8%, which is well covered with a 75% payout ratio, and the REIT has been steadily growing its dividend just like Armada Hoffler. Again, here we expect significant upside. We think that the REIT could eventually reprice at closer to 13 to 14 times FFO, and this would lead to about 50% upside from here. So to recap, EPR has great assets that produce very consistent and predictable cash flow, investment grade rated balance sheet, a management with a multi-decade track record of significant outperformance, and yet it's priced at a heavily discounted valuation of just around 8.5 times FFO. It's offering an 8% dividend yield that's paid on a monthly basis. It's been steadily increasing its dividend. The payout ratio is still relatively low today in the 70s, and yet it also enjoys significant upside of up to 50% to our fair value target. And this is ultimately why EPR is today one of our largest holdings at High Yield Landlord. Now, the third REIT that I'm going to discuss is called New Lake Capital Partners, ticker symbol NLCP. We kept the highest yielder for the last. After its recent dip, New Lake is today again priced at a near 10% dividend yield. It's just shy of it, but as it hikes its dividend once again in the near term, I expect its dividend yield to surpass 10% once again. And here you may ask yourself, what makes us so confident that such a high yielder will be able to sustain and grow its dividend? And it's simply the track record of the company. Since going public a few years ago, it has managed to grow its dividend in nearly every quarter. We've recently had the chance to interview the CEO of the company for High Yield Landlord, which is my REIT newsletter, and he seemed very confident about their future prospects. They own cannabis cultivation facilities mostly in limited license states. It limits the new supply of these properties, but the demand for cannabis keeps on rising, and as such, it increases also the value of the properties. Moreover, it enjoys very long leases with an average remaining lease term of about 14 years, and these leases also enjoy nearly 3% annual rent escalations. And very important to the story is that New Lake Capital Partners has almost no debt today, and so it could very significantly increase the size of its portfolio, earning large spreads over its cost of capital, and this would significantly increase its cash flow and dividend if it wanted to. But today it's deciding to remain conservative with its leverage, but in the future it has this optionality to add leverage on the balance sheet to boost its cash flow as well as its dividend. The payout ratio today also is still in the low end of their target payout ratio of 80 to 90%. I think it's about 82%, and therefore we are confident that another hike is just around the corner. So to recap here, we have a REIT with a very unique business model focusing on a growing sector with strong long-term tailwinds, with growing demand, but yet the supply of these properties is limited by the licenses. The REIT has strong leases that should provide consistently growing cash flow over the long run. It has no leverage, which is unique for a REIT. It has very strong balance sheet and provides the optionality of accelerating growth in the future. And yet currently it's priced at a 10% dividend yield. This is a REIT that has hiked its dividend nearly every quarter since going public. The payout ratio is still in the low end of its target. I mean, what else do you need in a REIT, really? I understand that cannabis is a bit riskier, and therefore this REIT deserves to trade at a relatively low multiple, but right now it's priced at about 9 times its FFO. I think that fair value is closer to 12 times. Actually, its bigger peer, Innovative Industrial Properties, ticker symbol IIPR, is trading at closer to 13, 14 times today. So even 12 times will represent a discount relative to it. But that would unlock about 30% upside from here, while you wait to getting paid handsomely with the 10% dividend yield. For this reason, New Lake today represents about 5% of our core portfolio at High Yield Landlord. And if you want to access the other 95%, you can join us for a 2-week free trial. It will be the first link in the description of this video. You won't be charged anything in the first 14 days. And if you decide to stick with us for the long run, you'll also get a $100 discount as part of our Black Friday sale. Once more, I would appreciate it if you click the like button. Let me know also in the comment section below what REITs you're buying for 2025. Thanks so much for your support, and see you at my next one. Bye-bye.